That news would substantiate. Investor optimism is going the other way. It is surging with the Citigroup Panic Euphoria Index. Who knew there was even such a thing? Reaching its highest level in almost 20 years. That move leading to comparisons to the dot-com bubble of the early 2000s. So is this time any different? Joining us now are Michael Jones, CEO of Caravel Concepts. Hope I got that right. And Matt Forrester, CIO of Lockwood at BNY Mellon Pershing. Matt, let me begin with, you. Froth is wonderful on a pint of Guinness. It is not so wonderful in the market. Are we too frothy right now, given where the economy is? And are we at some kind of danger point?
Well, I think any discussion that you would have on this topic has to start with the fact that the central bank, not just here, but around the globe, are pumping an enormous amount of liquidity into the system. So they've recommitted to $120 billion a month, and that's on top of global central banks that are contributing about 2/3 of a point of GDP every month to the monetary picture. So that's an interesting backdrop, and I think it's hard to get too bearish when those sorts of things are happening. That said, we're watching practically every measure that you would have a fundamental valuation in the equity markets press up against all-time highs, with the possible exception of those that are based on interest rates. So you have to look at the discount rate, and today we have $18 trillion worth of global negative sovereign yields, and that's helping to lift equity markets all around the globe.
I will come back to you, Matt, on a point that is in my notes where you say that the markets are largely policy dependent, meaning both Fed policy but also fiscal policy, because the second seems like a rather flimsy twig on which to base very high valuations. But, Michael, I want to bring you in and get you to react to the same question. Is there too much froth in this glass of Guinness?
Well, I think there's undoubtedly a lot of investor optimism, but we don't think it's transitioned into full-blown euphoria, the kind that leads to an outright bubble. Historically, as Matt mentioned, bubbles come when you get a big wave of printed money, and we've certainly had that. 21% of every dollar ever printed was printed over the last 12 months. However, you normally have to create a bubble, you have to have a broad-based fundamental rationale for higher asset prices. That's what creates the euphoria. That's what creates the bubble. And, you just had Steve Leisman go through the litany of gloomy statistics. You saw Bob Pisani say that if you are a company that's benefiting from COVID, you are soaring. But if you're someone who depends upon the broader economy, they're still kind of treading water. And I think until we get a broader-based economic recovery, that's going to put a cap on the euphoria. That's going to prevent the kind of broad-based excess that we saw back in 99 and 2000. We think that condition drops into place in 2021 when more stimulus, more Fed money printing, and COVID vaccines allow a broader-based economic recovery.
So let me make sure I'm understanding you here, Michael. What I'm hearing you say is you really don't buy that Citibank euphoria versus despair index being at the highest it's been in 20 years since the bubble, number one. You don't buy into that, but you do, if I heard you right there in the last point, you do worry about that happening sometime in 2021 as more stimulus comes in, as more money gets printed, and more people buy equities.
Yeah, I would focus less on that kind of euphoria indicator and just look at price action in the marketplace. Clearly the companies that really depend upon broad-based economic recovery, as Bob's data showed, they're still struggling. So do we have unbelievable froth and excess in certain segments of the market, in those areas that COVID-19 is lifting? Absolutely. But it's not broad-based enough for me to call this a bubble yet. For that to happen, we're going to have a broad-based rationale.